A busy end to the financial week as the latest non-farm payrolls data revealed that the US added only 142,000 jobs to its economy in September, far below the market's expectations for 200,000 plus, while August payrolls were also revised down to 136,000 from 173,000. Now, the much weaker than expected US jobs data sent the US dollar falling on the basis that a US interest rate rise this year, already in some doubt, now seems even less likely. The latest jobs report comes ahead of the release of the FOMC meeting minutes next week.
I think the minutes are obviously very important to watch, particularly in light of this data that we saw today. Obviously, the miss on the September payroll was one thing, but the revision downwards to August, which was already a poor number, is even more problematic. And I think the effects of that have been felt, particularly in the bond markets, where we've seen the 10-year yield go below the 2% mark. So this may very well change a lot of the viewpoints from some of particular Fed members who were exceptionally hawkish over the last number of months, and may, I suppose, maybe remove the possibility of a rate hike even in this year. Not December, not October, not 2015 at all.
Looking ahead to next week in more detail, we have an array of PMI data out of the Eurozone on Monday, as well as Japan and the UK. Brenda tells us what to watch for.
Well, the September number was a little bit lower than what was expected just gone by, so I think we could expect to see a little bit of a pop higher this time round. What is interesting to note that despite the fact that we have fallen into deflation in the Eurozone, there have been some pockets of growth within certain member states, so this could be felt within the PMI data, and of course that will more than likely prevent any immediate move from the ECB in respect of upping the ante on quantitative easing, even though there are many expectations that that will actually happen. And that's actually been felt as well within the euro-dollar pair at the moment. We are currently, as I speak, trading above the 113 metric, and there is a propensity for us to head towards 114, 114.30, and around those levels you normally get one of the Eurozone sources, or Euro ECB sources rather, talking it down. So that would be a very valid level for me to aim for the time being, as long as we remain above 113.
The Reserve Bank of Australia board meets on Tuesday to decide whether or not to cut the cash rate, now at 2%. Now, while a rate cut next week would be unexpected by the market, some analysts say a move by the end of 2015 or in early 2016 is not out of the question.
I don't think we'll see anything from the RBA this time round. We've seen the Aussie dollar fall to a 6-year low against the US dollar over the last number of weeks, and the fact that we haven't seen any move from the Federal Reserve puts a little bit less pressure on the RBA to actually make a move. That also, coupled with the fact that we have seen a bit of a bounce in commodities, particularly that of copper and even gold, in the wake of the non-farm payrolls just there now, and that in some respects does give them a little bit of breathing room to hang in there until maybe the first quarter of next year. So for the time being, the status quo will remain, but we expect to see the Aussie dollar remain reasonably range bound, probably a toppy in around the 71.30, 71.40 level, but the basic support, the long-term trend line from the 14-year lows, comes in around the 69.30 level, and you would expect that to be maintained for the time being.
The Bank of Japan will announce decisions on monetary policy next Wednesday and also again on October the 30th. Now, data this week indicated that the economy may have fallen into recession last quarter, reviving expectations that the Bank of Japan will have to step up stimulus later this year. Brenda discusses whether the market has in fact already started pricing in hopes for additional stimulus as soon as this month.
Well, I think the last time we saw the Bank of Japan ramp up their QE was in October of last year, which is probably what is pushing the idea that it could be this time round again. But they do have a new inflation metric, and that's the new core CPI, which excludes energy and food, and that actually rose 1.1%. So if you exclude all the things that matter, then you have inflation. So, you know, it's all a matter of changing the goalposts really here, and deflation, according to Kuroda, is just a state of mind. I don't expect to see anything happening in October from the Bank of Japan, again owing to the fact that the Federal Reserve have not moved just yet, but it is something that will remain in the pipeline. And while many are expecting to see the dollar rise against the yen, I think in light of what happened today and the fact that many will be pushing back their expectations, we could very well see dollar yen fall back as far as the 118.30 or thereabouts, and that's the bottom of the very recent range, but there is also an attraction towards the 120 level, but while below that, the propensity is to the downside, and that will more than likely keep pace despite the fact that we'll see nothing from the BOJ next week.
The Bank of England meet next week Thursday to discuss policy, but after UK GDP for the second quarter was revised down on a yearly basis, expectations for a rate hike from the central bank are being pushed further down the road.
Well, it does seem that for the time being that the markets are expecting the Federal Reserve to be the first one to the pop on in regards of interest rate hiking, and certainly some of the data of late in regards to the UK has been reasonably weak. And construction data today was better than expected and does show that there are better areas of growth, not just in the services sector. But next week we will have the services PMI, and that was fairly on the money the last time round, maybe a little bit weaker than what was expected. So you'd like to see that beat expectations, or at least meet them expectations, to put any sort of rate hike on the table. For the time being, I'm expecting to see the Bank of England status quo remain around the 8-1 voting, maybe to a 7-2, but ultimately I do sense that even with wage growth at a fairly decent high, a 6-year high of 2.9%, they may hold back in light of the geopolitical concerns that there are, which might make it problematic to make too temporary a move.
That's all for today's Week Ahead. Have a lovely weekend. Goodbye for now.